The nation's Federal Reserve, it turns out, made a record profit last year.
The bailout was far bigger than the Federal Reserve let the public or even members of Congress know at the time.
The Federal Reserve has been part of some of the most surprising and controversial events in the U.S. economic history.
The worst day on Wall Street since the crash of 1987.
The Dow traders are standing there watching in amazement. I don't blame them.
Their actions show how much power the Fed has and how their decision can lead to big consequences. Today we're going to look at the most shocking actions taken by the Fed, why they happened, and how they affected not only the economy but also the public's trust in this powerful organization. These events show that the Federal Reserve's decision can be a double-edged sword, sometimes helping in a crisis, but also creating new problems or making old ones worse. Number 1. Secret loans of 2008, $16 trillion bailout.
Banking institutions, the most trusted names in banking on Wall Street, were collapsing left and right.
During the 2008 financial crisis, the Fed secretly gave $16 trillion in emergency loans not only to US banks, but also to foreign banks like Barclays, Deutsche Bank, Credit Suisse, and UBS. These loans were meant to help stabilize financial systems around the world, but they were kept secret. Even members of Congress didn't know about them until an audit was done in 2011. Bernie Sanders said at the time, "This is a clear case of socialism for the rich and rugged. You're on your own, individualism for everyone else." He also said, "No agency of the United States government should be allowed to bail out a foreign bank or corporation without the direct approval of Congress and the President." Why it matters? These secret loan programs show the Fed's reckless willingness to use extreme measures without any oversight. It focused on saving banks worldwide, often at the cost of being open and honest with the public. When the public found out about this, there was a lot of anger. Many people were shocked by the secrecy and the huge amount of money involved, more than the entire GDP of the US at the time. The lack of transparency made people even more suspicious of the Fed's motives and raised questions about whether it was prioritizing big corporations over everyday people. Number 2. The Federal Reserve Act and the secret Jekyll Island meeting. In 1910, some of the most powerful bankers and policymakers in the country, including representatives from major financial institutions, met secretly on Jekyll Island, Georgia for 10 days. The 6 men involved were Nelson Aldrich, A. Piatt Andrew, Henry Davison, Arthur Shelton, Frank von der Lippe, and Paul Warburg. They met in secret to plan what would become the Federal Reserve System. The secrecy was so intense that they used only their first names to avoid anyone finding out who they were. This meeting led to the creation of the Federal Reserve Act of 1913, which completely changed the American financial system. Why it matters? The fact that the central banking system was created behind closed doors by a small group of elites has always been controversial. The secrecy made people feel that too much economic power was in the hands of a few, leading to mistrust that continues to this day. As von der Lippe wrote in his autobiography, "None of us who participated felt that we were conspirators. On the contrary, we felt we were engaged in patriotic work." Number 3. Balance sheet explosion during COVID-19. At the start of the COVID-19 pandemic, during Donald Trump's presidency, the Fed made a big move to expand its balance sheet, doubling it from $4 trillion to over $8 trillion in just a few months. This expansion was done by buying lots of assets like government bonds and mortgage-backed securities to keep money flowing through the economy. Why it matters? The speed and size of this intervention showed how determined the Fed was to stop the economy from collapsing like it did during the Great Depression. This was the fastest and largest expansion of monetary support in US history. In the short term, these actions helped stabilize the economy and stopped massive defaults and a potential financial meltdown. However, the long-term effects showed up soon after, as inflation surged in 2021 to levels not seen in decades. Critics said that the Fed's intervention led to an inflation crisis that became very hard to control, showing how tough it is to balance short-term support with long-term stability. Number 4. The aggressive interest rate hikes of the early 1980s. Under Chairman Paul Volcker, during President Jimmy Carter's administration, the Fed took drastic action to stop the runaway inflation of the late 1970s. By 1981, during President Ronald Reagan's first year in office, the Fed raised the federal funds rate to 20%, a rate unimaginable today. The goal was drastic but clear: to break the back of inflation that was in double digits and making life too expensive for Americans. Why it matters? This was one of the boldest efforts in central banking history to stop inflation. It showed that the Fed was willing to do whatever it took to keep prices stable, even if that meant a deep recession. The result was painful. High interest rates made borrowing very expensive, which caused consumer spending and business investments to crash. This led to a deep recession with unemployment reaching over 10%. However, Volcker's tough approach eventually succeeded in reducing inflation, laying the groundwork for the economic boom of the late 1980s and 1990s. It also showed that sometimes the Fed needs to cause short-term pain for a long-term gain. Number 5. Failure to act during the Great Depression. During the early years of the Great Depression, the Fed, under leaders who didn't understand how severe the crisis was, failed to give banks the money they desperately needed. This lack of action led to widespread financial panic and made the downturn much worse. Between 1929 and 1933, about 9,000 banks failed because there wasn't enough money, which caused people to lose trust in banks and pushed the economy deeper into crisis. Why it matters? The Fed's inaction during this time is now seen as one of the biggest mistakes in economic history. The Fed failed in its main role, to be a lender of last resort. The result was disastrous, a banking collapse that made a bad economic downturn much worse, with unemployment reaching 25%. This failure showed the importance of aggressive action during a crisis. It taught the Fed to take a more proactive role in future crises, like during the 2008 financial meltdown. Then again, maybe too proactive. Operation Twist, 1961 and 2011. The Fed used an unconventional policy called Operation Twist twice in its history. Once in the early 1960s under President John F. Kennedy, and again in 2011 during Barack Obama's presidency.
Fed could announce as soon as this week that it's dusting off the program in another attempt to boost economic growth by lowering long-term interest rates. And here's how Operation Twist might play out. For the past few years, the Fed has been buying massive amounts of both long and short-term treasuries to give support to the economy.
The idea was to make long-term borrowing cheaper without changing the overall money supply too much, encouraging both consumers and businesses to spend and invest. Inflation target missed for a decade. For 10 years after the Great Recession, the Fed struggled to reach its goal of 2% inflation. Despite very low interest rates and other measures, inflation stayed below target. Why it matters? The failure to meet the inflation target for so long raised questions about whether the Fed's usual methods were still effective and if they really understood modern inflation.
Inflation is causing stress. Bad news about prices in the grocery store.
Historically high inflation.
Low inflation can lead to economic problems like slow growth and less spending. Because they couldn't hit the target, the Fed had to rethink its approach, eventually deciding on a new policy of average inflation targeting, letting inflation run higher than 2% for a while to make up for lost time. Conclusion: the Fed's history of secretive decisions, unconventional policies, and aggressive actions shows just how much impact it has, for better or worse, on shaping the economy. Striking a balance between bold action and transparency, short-term fixes and long-term consequences is a theme that defines the Fed's role in the economy today. With Trump coming back into the Oval Office and Elon Musk already backing a plan to let presidents influence the Fed, things could get even more interesting. Trump himself has threatened to fire the Fed Chair Jerome Powell as well. Looks like this video could have a part 2 coming soon.